Okay, hi everyone. This is going to be the Chapter 13 PowerPoint lecture. So, as an overview here, right, what are we talking about in Chapter 13? Well, we're really going to be talking about decision making, right? Different types of decisions, scenarios, setups for how we should make decisions in running a business, and we'll give different rules that we can follow to help determine the outcome for these decisions. Now, what kind of decisions are we going to be looking at, right? So, a couple things here. What product should we sell, right? Should we sell product A, product B, product C? We need to decide, right? Decision making. Should we make or buy component parts, right? In other words, say we're making guitars, right? Should we make the strings that go with the guitars, or is it better to purchase those strings from an external manufacturer and put them, onto our guitars? What makes more sense, a component or a part? Should we make it or should we buy it? Likewise, what distribution channels should we use? From whom should we find the products? How much should we pay? What's an appropriate and reasonable amount? And then, should we accept special orders, kind of one-off orders for customers that may depart from our normal product that we produce? So maybe we produce cups, right? Coffee cups. Should we accept a special order to depart from our standard cup and make a special holiday mug for customer X who wants a holiday mug for their mother, right? We'd have to sit down and look at it and see if it makes sense. Now, these are just some of the decisions we'll see, and like I said, we'll explore them more in depth with rules. But with any kind of decision we're making, that is to say, with decision analysis, there's 6 concepts we have to understand. All right, so we have 6 concepts. Let's look at them individually now. Concept 1, decision making requires choosing between alternatives. So if we're making a product, right, we're trying to decide which product to make. Should we make product A, B, or C? Right? That's an alternative. Each one is a different choice. So it's kind of implicit. In order to make a decision, you have to have 2 different, at least at minimum, 2 different alternatives. Do this or do that. And with that being the case, with making a decision presupposes that there's alternatives, that means we first have to define the alternatives. So in the make or buy decision, right? Should we make those guitar strings or should we buy them from an external manufacturer and put them on the guitars? Should we keep or drop a business segment? Right? We're kind of really just laying out our options, laying out our alternatives, our choices that we could make. Option A, we can make it. Option B, we could buy it. Option A, we could keep it. Option B, we could drop the line or the segment. All right, so that's kind of concept number 1. We're choosing between alternatives. We need to define those alternatives. Concept 2 here says, after defining the alternatives, we need to identify the criteria for choosing between them. Thus, we should consider the relevant costs and benefits and ignore irrelevant costs and irrelevant benefits. In other words, this one's just saying here, once we define the different paths we can take, right, make, buy, keep, drop, whatever our alternatives are, we need to figure out which one are we going to pick, right? So what's the rule set, or what kind of framework should we follow in deciding that and making the decision? Right? Well, we have to consider only those relevant, right? If it's relevant, we consider it. If it's irrelevant or not relevant, we ignore it. All right, let's look at concept 3 here. It says decision analysis uses differential analysis, namely focusing on future relevant costs and benefits that differ between alternatives. All right, so let's see how they define this here. A differential cost, that's going to be a future cost that differs between any two alternatives. Specific variants of these are incremental and avoidable costs. And then a differential revenue is a future revenue that differs between any two alternatives. So the idea with this is, let's say it's like a make-buy decision, right? In light of choosing option A or B, what would our costs be, right? Are the costs going to differ between them? Are we going to have revenues that are different between them? Those are going to be, a future relevant costs and benefit. We have to decide about that and weigh that into our decision analysis. Now, incremental costs, those are costs that increase between alternatives. So like add-ons on a car. So for example, right, should we buy the base model or should we buy the deluxe model of the car? To the extent there's add-ons or features there with it, that's going to be a incremental cost. Another kind of cost here that we should think about or talk about are avoidable costs. So these are costs that can be eliminated by choosing one alternative over another. So here's an example of it. Say that you have two choices, right? One is you can watch a movie from home on TV for free, right? Let's just say it's on the public TV channel, so you don't got to pay anything. That's option one. Option two would be going to a movie theater and paying money and you could see the movie. Well, in this case, right, if we were kind of weighing these two decisions, a relevant cost here would be the avoidable cost of the ticket. In other words, if we watch the movie at home on TV, we could avoid the cost of paying for the ticket of seeing the movie at the theater, right? So it's an avoidable cost, that ticket. Concept 4 here. A sunk cost is a cost that's already been incurred and cannot be changed by any future action. One thing about sunk costs you got to be aware about, they're irrelevant costs. You should ignore them. They happened in the past. You can't change it. It is what it is. It shouldn't affect your decision making moving forward. So let's say that we're in our business and we're debating whether we should keep or sell this truck in our business. And maybe when we bought the truck, we were a little ambitious. We thought we were going to use it. It turns out we really don't have the need for this truck. Here we are, right, making keep the truck or sell the truck. One thing that shouldn't come into play in this analysis is the fact that in the past, we paid a lot for the truck. In other words, one, that's kind of an emotional sentiment, right? And two, it happened in the past. We can't do anything about the past. That's out of our control. The thing we need to focus on are the relevant, like current and future things that are going to happen. If we're not going to use that truck moving forward, maybe we should sell it, right? So what we paid for it in the past, that's a sunk cost, right? It's like throwing the anchor and it sinks. It's sunk, already happened. It is what it is. Ignore those costs. All right, concept 5. Future costs that do not differ between alternatives are irrelevant costs. All right, so for example, as I have here, you will buy a pizza tonight for dinner regardless if you attend a movie in person or you watch from home, right? So in other words, let's just say you're making your plans tonight. You have two options. You can watch a movie at home. You can watch it at the movie theater. Either way, right, if you watch it at home, you're going to order the pizza, or if you go out, you're going to pick up the pizza and eat it on the way there, right? That's going to be an irrelevant cost. The cost of the pizza, it doesn't change between either outcome, right? Either choice you make, it's still there. So it's kind of like it is what it is type thing. Similar to a sunk cost in the sense that it's basically it's not out of our control, but it's something that's going to happen either way. Okay, concept 6. All right, decision analysis should consider opportunity cost. An opportunity cost is the potential benefit that is given up when one alternative is selected over another. All right, so as I have here, if I select X, then I miss out on Y. All right, so let me think of some simple examples for opportunity cost. So first off, with opportunity cost, it's a relevant cost, so you should consider it. Second is kind of a maybe a simple example here. Let's say you graduate high school, you make the decision to go to college, right? You're studying at a college, taking classes, and you don't work. So the idea with that is if I select X and I go to college, then I miss out on Y, maybe the income from working, right? So it's a very kind of black and white situation. It can also be a little bit more quantitative, right? So say, for example, that you have a job where you get paid $50 an hour. And with that job, every hour you work, obviously you get $50, and then you have home improvement projects you have to do. I don't know, let's say you have to paint the house or something on the inside of the house. So the idea with this is if I select X, I paint the house, then I miss out on $50 an hour. So in that kind of situation, you have to compare, is it cheaper or am I better off by just paying someone to paint the house? Is it going to cost me less than $50 an hour? So that could be like a situation there. All right, so with that, let's look at an example here. It says you live in Boston and you want to visit a friend in New York City. You're trying to decide between driving there or taking the train. Below, please find more specific information. Okay, so let's kind of zoom in on this. All right, they're giving us some information about automobile costs here. First one is item A, annual straight line depreciation on a car. So the annual cost of fixed items, $2,800. If they do it on a per mile basis, it's 0.28. Cost of gasoline. We can see this is a little bit dated textbook, 240. We're not at 240 anymore, right? So if you break that down per mile, maybe it's 10 cents. Annual cost of insurance per mile, maintenance and repairs per mile, parking fees at school per mile, total average cost per mile. You add all these guys up. In other words, things that we're looking here, at least in this chart, is some of the yearly costs as well as other costs of maintaining the car or driving the car, putting it in a per mile basis, adding it up, and then saying, hey, on average, the total cost per mile is roughly 61 cents, okay? Here's some other information they're giving us. Reduction in the resale value of the car due solely to wear and tear is like 8 cents per mile. In other words, if you use this car, it kind of gets beat up, right? So it's going to lose some of its value when you use it. When we quantify that, we're saying it's like 8 cents per mile. A train ticket here, okay, so the cost of a round-trip train ticket from Boston to New York, it's $1.14. One of the things here, benefit of relaxing and being able to study during the train ride rather than having to drive. It's a little bit more of a qualitative than a quantitative amount. It's something, it's like a characteristic there, but we're not putting a dollar value on it per se. Also, hey, cost of putting the dog in a kettle while gone, $80. Some other kind of more qualitative items here. The benefit of having a car available in New York City, hassle of parking in New York City, and then the cost of parking in New York City, right? So there's kind of like good and bad with each of them, right? The good is if you drive, you have the freedom and flexibility of having a car while there. The bad is we got to calculate this on a per mile basis. We're going to have to deal with parking, so on and so forth. With the train, taking the train, there's good and bad, right? The good is it's a flat rate for the train. We'll be able to relax while we're on the train. Maybe we can study a little bit. The bad is, though, we kind of miss out on having a car in New York City. We have to walk everywhere, take the bus. So that's just the idea. They're giving some information here between driving and taking the train. Now, if we go through and we look at these items, right, to see if they're relevant or not relevant, we're going to go through and give them some teeth here to kind of examine this, all right? So A, the cost of purchasing the car. Well, that's going to be an irrelevant sunk cost. In other words, hey, we already spent the money on the car. The fact that the car cost us X or we bought it in the past should not affect our future decisions. The cost of gas, that is going to be a relevant cost. In other words, if it's green here, it's not relevant. If it's black text, it is relevant. So the idea with the cost of gas, that's a differential cost. If you drive, you'll have the cost of gas. If you don't drive, you won't have the cost of gas. It differs between the alternatives. Annual insurance, right? That's going to be an irrelevant cost. In other words, it's a cost that doesn't differ between the choices. If you take the train or you drive the car, either way, you're going to have to pay that car insurance in the future. So it's not really relevant to this. It doesn't differ between the choices. You're kind of on the hook for it either way. All right, car maintenance, that is a differential cost. In other words, by virtue of driving, we're going to put more wear and tear on our car. We're probably going to increase our maintenance costs. If we take the train, though, don't got to worry about that, right? So that would be a cost that differs between the alternatives. Home Boston parking pass. This one here should also be green. So I'm going to make that green right now just to kind of keep it consistent. So this is a future cost that doesn't differ. In other words, if you bought a parking pass back in Boston in the past, you're going to have that cost either way. Doesn't really matter, right? You've already, in some ways, it's a sunk cost. You paid for it in the past before. It is what it is. Okay, total cost per mile. So this is kind of mixed, right? In other words, portions of it, to the extent it's comprised of the above items, can be relevant or not relevant. So it depends which kind of items there. All right, decline in resale value. That's going to be a relevant cost. In other words, if we drive, we'll put more wear and tear on. We can't sell the car for as much in the future. So that's going to be a change in revenue by virtue of which option we pick. Drive or take the train. Obviously, the train ticket is going to be a relevant cost. It's a differential cost. If you take the train, you got to pay for the ticket. If you don't take the train, you don't pay for it. So it's a cost that differs between the choices. Things like the qualitative benefits, those are going to be differential future costs and benefits. In other words, depending on which one you pick, do you want to be able to relax on the train, or do you want to be able to have a car in New York City and see your way around? So which one you pick will differ. It will have a different outcome. So it will differ. Dog kennel costs. I'm sure if you have a dog, either way, if you fly, drive, take a train, any which way, somebody's got to watch your dog, right? So that's a future cost that doesn't differ between choices. We're going to ignore it in the decision. And then finally here, parking in NYC, that will be a differential cost. So obviously, if you drive, you're going to have to pay for parking there. If you take the train, you're good. You don't have to pay for parking. Okay, so with all of that, right, based on what we defined as relevant versus not relevant, they're giving us some information here to compare it right? So they have the relevant financial cost of driving to New York City. Gas, that's a relevant cost. Let's say it's 460 miles from Boston to New York City. We're looking at roughly 10 cents a mile here, 46 bucks. Maintenance and repairs, right? That's a relevant cost. 460 miles on a per mile basis, we're looking at 29 bucks. Likewise, the reduction in the resale value of the car due to the wear and tear from the trip. Okay, we said that's a relevant cost. 460 miles times the 0.08 cents per mile. We're looking at 36 bucks. And then the cost of parking in New York City, 2 days times 25 bucks a day, 50 bucks, right? So in this way, our total cost would be $1.62. That would be the relevant financial, right? So we're not necessarily looking at the qualitative characteristics here. We're looking at just those quantitative items. This would be the relevant financial cost of taking the train to New York City. In distinction, right, the round trip train ticket, if we did that, was $1.14. So you can see, right, that it's better here to take, from just a pure cost perspective, take the train. However, right, in real life, sometimes cost isn't really as big of a factor. In other words, maybe it's cheaper to maybe drive from Pittsburgh to California than it is to fly. But if you start factoring in those qualitative factors, maybe you don't want that headache of driving for 4 days straight, right? So again, this is just what we're looking at here is just the financial part of it, just from a numbers perspective. So it says here, we just use the differential approach, namely looking at relevant costs and benefits for decision making. Okay, now we'll consider another approach, namely the total cost approach. And really what's going on here is this is going to analyze all of the costs and benefits, both relevant and non-relevant. And when we're deciding which approach to take, right, the differential approach or the total cost approach, the idea with this is the differential approach tends to be more commonly selective. You don't need as much information. You don't have to commingle costs. It's a little bit simpler to do. So 2 different methods. We first looked at the differential approach. It's the more common approach taken. Okay, so let's go on to the next slide here. All right, so it says, let's pretend we are a woodworking company and we are considering renting a machine for $3,000 per year to help us produce butcher blocks. Okay, we work with wood, thinking about renting this machine to help us make our product of butcher blocks. And below, they're giving us some information regarding this matter. Okay, so if we zoom in on this, all right, it looks like they're telling us how many units we produced and sold without the new machine or with the new machine, right? It looks like 5,000. What do we sell it for? $40 either way. What's the direct material cost? 14 bucks. What's the direct labor cost? 8 bucks versus 5. That makes sense, right? If you buy the machine, it's cheaper than what it would be is if you had like a human being doing it. Then the variable overhead cost per unit is 2 bucks. Fixed expenses in total, or the other ones, are 62,000. Fixed expenses of renting the machine is 3,000. Okay, so the main difference between these is going to be this this direct labor cost per unit, the 5 versus the 8, and then the fixed expense of renting the machine, 3 versus 0. In other words, if you rent the machine, it's going to cost you 3,000 bucks. It's going to lower your direct labor costs. If you don't rent the machine, you won't have that 3,000, but you're going to have higher direct labor costs. Okay, so let's analyze this under the total cost approach. All right, so it says the chart below shows the total cost of each alternative, with the third column showing the differential cost. Okay, so here's without the machine, with the machine, in the differential costs and benefits, right? So as you can see here, if we run through it, you're going to have your sales minus your variable expenses, get you your contribution margin, back out your fixed expenses, get you your net operating income at a high level, right? Just like how we looked at it before with those, all of the costs and kind of mapping out the difference, the main difference here between these is going to be the direct labor cost, right? 40 versus 25, which gives the differential cost of 15,000. And then we're going to have the cost here of renting the machine, 0 versus 3 is going to be 3,000. So the idea with these overall, if without the new machine, we're going to have 200,000 in sales, we're going to have 80,000 of a contribution margin, and 18,000 of net operating income. If we have the new machine, right, we'll have $200,000 of sales, a contribution of 95, 15 difference there, right? And then total net operating income of 30, right? So the 18 and the 30, the difference is 12, which also equals the 15 minus the 3 right here. Okay, so we were looking at all of the costs there under the total cost method. Let me zoom out here. All right, so we're going to move into some of the different decisions we might have to make, right? Because I said this chapter is about decision making. There's various things or types of decisions we have to make. So the first decision we're going to look at is whether you should keep or drop a business segment. Right, so a business segment, it's kind of like if your business does a bunch of different things, there'd be different segments in it. So, I don't know, maybe CVS, right? They have a pharmaceutical segment, and then they have maybe like a retail segment. It's like two things. It can be like internal to the same building. It can actually be different things as well, right? Like I recently saw a story, Kellogg's, the cereal company, they have kind of a cereal division, they have a snack division, and then they have like a plant-based food division. So in the analyzing those, maybe we'll just stick with Kellogg's, right? And the idea, I was watching a documentary, I guess cereal sales have fallen over the last 15, 20 years. In general, people aren't eating as much cereal, so Kellogg's kind of in response to this is diversifying and changing their business. In any event, right, imagine you went up to Kellogg's and you said, should you keep the cereal division, right? Or should you drop it, get rid of it? That would be the idea with keeping or dropping a business segment. Now, let's imagine, for purposes of this course, that we're considering a drug company that has 3 different product lines. So the segment can be like an actual operating segment or like a different product line. And the drug company, right, they have drugs that they make, they have cosmetics that they make, and they have housewares. So kind of like A, B, and C, 3 different products. Now, the drug company, they're considering dropping the houseware line because it nominally, right, when you look at it, it shows an $8,000 loss when you look at that segment. The thought here is that, hey, if we get rid of this houseware segment, which is an $8,000 loss, that getting rid of it would be like increasing our revenue by $8,000. However, as we're going to see, this is an error, right? That is to say, the income statement, it's not going to break out our fixed expenses that can and cannot be avoided if the line is dropped. Once we do this, right, we start to break out our avoidable versus our non-avoidable expenses, we'll see that we should, in fact, keep the housewares line. Okay, so let's give this some numbers here as to what's going on, right? So we'll start over here, right? So we have our drug company. They have 3 products. They're drugs, cosmetics, and housewares. It looks at it here, right, originally, and they say, hey, we're at an $8,000 loss. If we get rid of this, maybe it will increase our revenues by $8,000. And essentially what they're doing here is they have a total column that adds the three of them together, and it's just going to be that contribution margin income statement, right? The sales minus variable gets you contribution, minus fixed gets you your net operating income. Here's the deal though with it, right? This income statement over here does not break out the expenses for each product or division by those that we can avoid versus those that we cannot avoid. Right? So if we go over here and we look more specifically at some of the information here with the fixed expenses, right? So we have total fixed expenses of 28, all these guys. Some of them we can avoid and some of them we can't avoid. So why we care about this, if we can't avoid the expense, right? It's like something that's going to happen whether we keep or drop the line, then we got to think about that whenever we decide to keep or drop the line. Okay, so if we look at this, right, here's the total that gets you the 28 right there. We break it out versus not avoidable versus avoidable. So in other words, we're going to be on the hook for 13. It's not avoidable, but $15,000 we can avoid, right? So when we look at this, right, if we go to the next slide, it says, remember that some of our fixed costs are avoidable and some are unavoidable. All right, so for the housewares line, we said 13 are not avoidable, 15 are avoidable. Here's the rule, right? If you want like just to keep it simple to a rule, how do I make these decisions? The general rule is going to be that you should drop a unit or a product or a segment if the avoided fixed costs from dropping the unit are greater than the contribution margin lost from dropping the unit. So here, right, the $15,000 of avoidable fixed cost, grab it from right there, are going to be less than the $20,000 lost contribution margin from dropping. Accordingly, because we don't meet the rule, right, it's less than, it's not greater than, we should not drop the unit. In other words, we should keep the business segment. In other words, if we dropped it, we would lose more contribution margin than expenses we would avoid, right? So here's kind of showing, the idea with it, right? So if we keep housewares and we drop it, what's the difference? Some of these, right, if we drop housewares, some of these fixed expenses over here, we're going to have it either way, right? So when you look at it, right, if we keep it, looks like we're going to be at an $8,000 operating loss where we saw originally. If we drop it, we're going to be at an even worse loss, right, because we still have these expenses associated with it. The differential there is $5,000, right? So that's what it says. Let's see, where's that amount? Right, the $5,000. Well, it's over here. You can see that, right? So it's just basically saying, here's the rule. Know the rule right here. That'll give you what you need to do. This is explaining the rule, right? It's basically just showing that, 15. You're still going to get hit over here. Some of these fixed costs are going to be fixed regardless. They're unavoidable. All right, let's move on to the next decision that we'll have to make, right? Make or buy. And I talked about this a little bit with, if we're a guitar company and we're making guitars, should we, we make the body of the guitar, this and that. We don't have the strings. Should we make the strings or should we buy the strings from an external party? That's just like one example. And the idea, as I have here, another decision managers may need to make is whether they should make or buy a component. Just kind of a variation of this, whether you should perform a service for somebody or in the business or outsource it, variation of it. But when you have a vertically integrated company, essentially that is one that controls its supply chain from manufacturing all the way to end sales. essentially we're trying to decide whether we want to adopt or depart from this model. Do we want to make stuff and create our business in such a way that we can go from soup to nuts, make the whole thing and sell it, or depart from this, that is to say, make some of the products, buy some of it from external parties, and then sell the product? Now, vertical integration, where you basically stack up your businesses, you have different abilities within the business to make the whole product. Maybe you make the strings, you make the body of the guitar. They allow for less dependency on external suppliers and more quality control. In other words, if you're making those strings for the guitar, right, you have better control over them. You can make sure the proper materials used, they come out the way you want, they sound nice, and you're not as dependent on an external company. Now, as I have here, however, purchasing from suppliers, right, if you buy the guitar strings from somebody else and those suppliers have economies of scale, like they can mass produce it for a cheap price, we may be able to actually buy it for less than it would cost us to make it, right? So we kind of have to decide here, and weigh these items against each other. So let's use another example, right? Suppose that we have a mountain bike company and currently they make the gear shifters, but they're contemplating buying them from external suppliers. So the gear shifter is that like little thing where your hand is on the bike where you press it and it shifts and then the gears shift, right? So we have a bicycle company right now, they make that, but they're saying, hey, instead of us making this, should we buy it from an external party? And they're giving us some information here. It says the cost of making 8,000 gear shifters is as follows. So it has the direct material, direct labor, variable overhead, supervisor salary, depreciation on the equipment we use to make them, and then some allocated overhead on a per unit basis, and then for the entire 8,000 units. In short, right, if we make them, right now we're looking at a total cost of $21 per gear shifter, and ringing in for all 8,000 gear shifters, $168,000. So an outside supplier, Bikes R Us, a different company, they basically have come to us and they say, hey, instead of you making those gear shifters, the 8,000, what we can do is sell you 8,000 for $19 a pop. In other words, $152,000. Well, what should the company do here? In this situation, they're going to have to look at the relevant costs. That is, those that are going to differ between the choices. And in this way, we're going to have to look at the costs that can be avoided by buying from the external supplier. All right, so let's give the rule for this one. The rule is you should make the component, so make the gear shifter, right, if the avoided costs from buying are less than the cost to purchase. So, for example, if by buying from the supplier, we would avoid $112,000 in cost, but it would cost us $152,000 to buy, then we should continue to make the component, right? The idea is this is the general rule. If you fail it, then the opposite's going to happen. If you fail this rule, if it's greater than, well, then you should buy the component. All right, so in this situation, right, they're saying you can buy them for $1.52. Over here, if we make it, right, we're looking at our relevant costs, our direct materials, our direct labor, our variable overhead, our supervisor salary. We get rid of our non-relevant costs, right? That's going to be at $1.12. So here, right, when you compare the relevant costs with buying it, it's actually cheaper to, in this case, make the gear shifters, right? So that's what it's saying here. The $112, if by buying the supplier we would avoid $112,000 in costs, that's going to be less than purchasing it, then we should make it, which we do here, and that's showing a financial advantage of $40,000. Okay, in that bike example, right, we have to, kind of modify it a little bit here. So it says in our example, we assume that the space being used for making the gear shifter has no other use, and that there was an opportunity cost of 0. Right? In other words, we just didn't really factor into that count that we just assumed that like the area in the facility, we weren't going to use it for anything else. We wouldn't get anything out of it. However, let's say that if we could use the idle space to make another product that would generate $60,000 of revenue, that if we counted this, namely the opportunity cost, then it would make more sense to buy the gear shifters. In other words, if we factor in, right, if you make it here, then you miss out the opportunity cost on $60,000 in that case of additional revenue because you're utilizing that space in the factory. You can't do two things at once. So the total cost is going to be $1.72 versus $1.52. In this way, it's actually cheaper to buy it from the outside supplier. So again, you have to look at it, make buy, not only the relevant costs, but also, if given to you, the opportunity cost. All right, the next one here, special order decisions. So another decision managers must make involves special order decisions. It's basically like a one-time, one-off special order. Right? It's not part of the normal operations of the business. Okay, so sticking with this kind of bike company, right? Let's just assume that the bike company has a set of like 5 standard bicycles they make, like a small, a medium, a large bicycle, one for a boy, one for a girl, etc. Whatever the case is, they have a set standard of them. And it says, suppose the bike company received a special request to make 100 custom bicycles for the police department. And so that's like a special order. We don't normally make police bicycles. We just have our standard small, medium, and large bicycle we make. We can modify them for the police department, maybe put a little badge or something on them to help meet the order. But should we do this, right? Is it better that we just kind of keep making our standard bicycle, or should we accept this special order from the customer? So here's the rule, right? You should accept a special order if the incremental revenue from the order is greater than the incremental expenses. So currently, let's say our standard bicycle, it costs us $564 to make, right? The direct material, labor, manufacturing overhead. If we're going to do these police bicycles, right, it's going to cost us $70 more in costs for bicycles, right? So we're going to have to tag onto this an additional $70 in that case. However, what we're going to see here is that we should accept the special order because the incremental revenue in this case is going to exceed the incremental cost. In other words, the 55 is going to exceed the incremental cost of 53. So if we look at it, right, we're going to sell per unit, in this case, 558 times 100 bikes. We're going to have our direct material, our direct labor, our variable manufacturing overhead here in this case. And then we'll have our special modifications. And, we just do it times 100 bikes. We're looking at variable costs there of 5080. We got to purchase some stencils of 2400. Add those together, we're looking at 53.2. Right, so this order, if we do it, we'll get 55 of revenue and we'll have 53 of expenses. We should accept it. We're going to make money. All right, another decision making situations is going to involve volume trade-off decisions. And essentially what happens here, this occurs when a company does not have enough capacity to meet demand, and it must decide which products to make due to these constraints to maximize products, right? So maybe you're just selling out of inventory left and right. You have 3 different products. We can only do so much, right? Which products, given our limited ability to produce them, should we sell? Now, a constraint, that's going to be anything that prevents you from getting more of what you want. And a bottleneck, it's kind of like a constraint. It's a point of congestion in a process or a system. So a constraint might be like, hey, we don't have enough money for new machines to meet demand. Or a bottleneck may be we're sitting here, we're waiting for a part to come, and we're getting everything jammed up at this bottleneck. We're waiting for the parts to arrive to finish the product. So in dealing with strained resources, right, managers should identify the mix of products that maximizes the total contribution margin. And specifically, we should favor the products that provide the highest contribution margin per unit of constrained resource. So, for example, let's consider a company that makes saddlebags for bicycles. And let's say they have two different models. Okay, so the saddlebags are like the things you throw over the bicycle, and I guess you could put your phone or a water bottle in it or something, maybe a newspaper. But we're dealing with the company that makes them. And right now they make kind of Model A and Model B. Right, so it says, here they have a Model A, this mountain pannier, and they have Model B here. And looks like the selling price, they sell this one for $25, that one for $30. We have variable cost of $10 and $18. So it looks like the contribution margin on each one is $15 and $12. We got the contribution margin ratio of 60 and 40%. Okay, so it's just some information. We've seen this stuff before in previous chapters. So it says, in our production, we have a bottleneck with the stitching machines. In other words, it's only available for 12,000 minutes per month, but to meet all our demand, we would need $15,000 per month. 15,000 minutes per month. In other words, we don't have enough stitching machines. It's a constrained resource to meet our demands, right? So here's the idea with it, right? We have Model A. The demand is 4,000 units. Each one takes 2 minutes of stitch time on the machine. So you got to run it through the machine. Takes 2 minutes to do. Model B, our demand is 7,000 units. It takes 1 minute to go through the stitching machine, right? So if you take the 8 plus the 7, to meet all of our demand, right? People want to buy 11,000 units. In order for us to meet it, we would need 15,000 minutes on the stitching machines. However, our current stitching machines, they can only produce 12,000 minutes a month, right? So that's why this is a constrained resource. So to decide which one should we focus on, right? How should we do this? Well, what we have to do here is look at the contribution margin per constrained resource. While the first model, right, if we look at this guy over here, has a higher contribution margin, maybe you initially look at it and you say, pick that one, right? It's you have a bigger contribution margin. When we actually examine the contribution margin in relation to the resource that's constrained, we see that it's actually better to pick the second model, right? So what we do here is we take the contribution margin per unit, we divide it by the number of time, the time here, the stitching time for each one. We're looking at $7.50 per minute for Model A, $12 per minute for Model B. It makes more sense here. We're going to have a bigger contribution margin per unit of the constrained resource. That is to say, based on the amount of time it takes to go through the stitching machine, we should make Model B, right? That's what it's saying there. And what it says here is, in short, if we use our limited resources to focus on the product with the lower contribution margin, Model B, we can make more of that product given that the time constraint and our overall contribution margin will be greater than had we focused on Model A, the product with the higher contribution margin. Just another way of saying that, hey, Model A looks better up front, maybe $15 per unit, but you'd only be able to churn out 30 of them and you'd really only make $450. When you do the math, 12 bucks on Model B, you could churn out 60, you'd make more money there, right? So this looks better initially, but when you do the math, in light of how many you could pump out on the stitching machine, given our constraint there, makes more sense to go with Model B, okay? All right, so it says managers should be sure to manage constraints when possible. When a manager can increase the capacity at a bottleneck, this is referred to as relaxing the constraint. So basically, if you resolve a bottleneck, it's like called relaxing the constraint. In our prior example, the manager could consider having the sewing department, maybe they work some more hours, right? You have to balance the incremental cost of that overtime against the incremental benefit from using the constraint. You'd have to do some math to see if it makes sense to do that. Other ways that they could ease constraints include things like general ways that are used, overtime, subcontracting, buying more machines, shifting workers to the bottlenecks. There's various ways. If basically, if you've ever worked at a company and there's like a part of it that's like slow or not, moving efficiently, there's ways that a business will deal with that to make it more efficient. All right. The last kind of area or decision we're going to look at is whether we should sell or process further. Right now, in some industries, 2 or more products, namely a joint product, can be produced from a single input. So the point in the manufacturing process where the joint products, for example, flour or bread, can be recognized as separate products is the split off point. So whether we should stop the product now or process it further, maybe sell for a higher price, this is known as a sell or process further decision, right? So here's the idea with flour and bread, right? We make and we create flour, right? Should we sell the flour right now as it is, or does it make more sense that we should process it further, put the flour in, mix it, and make bread and sell the bread, right? At that kind of point, once we have the flour, it splits off. You either sell the flour, that's kind of road 1, or road 2, you process it further and turn it into bread and sell the bread. What should you do, right? So in deciding whether to sell or process further, managers should ignore all the costs up to the split off point. It's basically a sunk cost, right? All that happened, it's in the past. It's the same regardless of the choice you pick. Now the rule here is going to be that you should process it further if the incremental revenue from further processing it, that is to say the revenue at the later point less the revenue at the split off point, is greater than the incremental costs to process the item. So let's show this through an example, right? Imagine that we have a wool company, right? They sell 3 types of wool. They have coarse wool, fine wool, and super fine wool. It's kind of like how soft is it? We have a little bit rough, we have medium, and then we have like super soft wool. Now, each type of wool can be sold as is, or it can be processed further, dyed, and then sold, right? So if we look over here at this, right, we have wool, it's a joint cost, and then we could have undyed coarse wool, undyed fine, undyed super fine, right? So it's like joint cost, then we get into our 3 different products here. The question becomes, once we have, right, our 3 different products, should we process them further, right? Basically dye them a color and then sell them further. It's kind of like flour versus bread, undyed regular wool versus dyed wool, right? Should we sell it as is or process it further once it's colored, right? And this is showing the sales value at each thing. So we could sell it for 120, 150, 60. The incremental costs here, 50, 60, 10. And then if we were to, in this case, process it further, what we could sell it for, 160, 240, and 90. All right, so in this case, right, it says if the company decides to further process all three types of wool, it will have $130,000 in profit. Right, so what's going on here is you add up the combined final sales values, the 160, the 240, the 90, from right here, the 160, the 240, the 90, that gets you 490. And then you have to back out the cost of producing the end products. Right, so it's the wool, the cost of separating the wool, and then the cost to dye. You add those up, you're at 360. The profit there is going to be 130. Okay? Now, when we apply the rule over here, right, this process further rule, to sell or process further, we see that it doesn't make sense to further process all three items. Instead, we would be better off not dyeing the coarse wool and selling it at the split-off point. So in other words, we fail the rule here. The process further, the incremental revenue is going to be less than the incremental cost to further process the item. And if we go back here, right, here's kind of showing what's going on with it, right? Here's the final sales value after further processing, less the sales value at the split-off point. So there's the incremental revenue, right, less the cost of further processing. So we have the incremental revenue, further processing. 40 is less than 50, right? We're going to be at a disadvantage in that case for the coarse wool, right? These guys over here, we're going to be at an advantage of doing it. So you have to just look at each product line, right? So here, the coarse wool, you fail the rule, sell it at the split-off point. The fine and the superfine rule, 90 is greater than 60, 30 is greater than 10. You're going to, in that case, pass the rule. So you should, if you meet the rule, do what the rule says. Process it further. Now, this says, following this approach, our profit would increase by 100, would increase to 140, namely an amount greater than the original 130,000 in profit. Right, so this is just showing, you'd be at 140 if you only dyed two of them over. So dyeing two of them, like when I say dyeing, I don't mean like killing, I mean changing the color. If you do that, you're at $140 of profit. But if you dye all three, right, you're at $130 of profit. So it's just showing you how this decision makes you the most profitable. If you were to decide which ones should I sell, which ones should I process further, well, there's our rule that tells us what we need to do. So these rules are kind of simple, but once you start applying some numbers to them, they can get a little bit complicated. So I would suggest, we're going to look at the problems that'll help in the video, but look at some of the optional multiple choice questions. Those will be helpful. And with that, we're at the end of the PowerPoint here. I'll see you in the next lecture. So thank you very much. We'll see you on the next one.